10,000. That is how many jobs the U.S. economy will lose every month for the rest of this year, according to Goldman Sachs. On the same day that estimate landed, TransUnion data showed Gen Z credit scores have fallen 27 points since January. Two different numbers, two different causes, one destination. The paycheck that disappeared. The S&P 500 dropped 1.74% on Thursday. The Nasdaq fell 2.38%. The Dow shed 469 points. Brent crude surged past $106, up more than 4% after President Trump told a cabinet meeting that energy prices could climb higher. The VIX spiked 8.3% to 27.44. Goldman Sachs published a research note Thursday morning, estimating the oil shock from the Iran war will suppress U.S. payroll growth by roughly 10,000 jobs per month through December. The losses will concentrate in restaurants, hotels, and retail, sectors where consumers cut spending first when gas prices rise. Goldman now expects unemployment to reach 4.6% by year-end. This is not a forecast of mass layoffs. It is a forecast of hiring that quietly stops, restaurants that don't replace departing workers, hotels that delay seasonal staff, retailers that freeze headcount. The economy doesn't crash, it slowly suffocates. The OECD reinforced the picture from a different angle. Its latest projection puts U.S. inflation at 4.2% for 2026, the highest revised estimate in 4 years. The organization explicitly stated the Federal Reserve is frozen, unable to cut rates into rising inflation, unable to raise them into a weakening labor market. The stagflation trap that economists warned about in February is no longer theoretical. The credit score that collapsed. Thousands of miles from any oil field, a different kind of damage is accumulating. Gen Z credit scores are in freefall. TransUnion reports that delinquency rates among borrowers restarted aggressive student loan collections in January. Default rates on federal loans have hit a post-pandemic high.
The mechanism is straightforward. During the Biden-era forbearance, roughly 43 million borrowers made no payments without penalty. When collections resumed, millions of young Americans suddenly owed monthly payments they had never budgeted for. Missed payments became 30-day delinquencies. Delinquencies became credit score drops. A 27-point average decline in 3 months is severe, enough to push borderline borrowers below the threshold for auto loans, apartment leases, and credit cards. Fortune reported Thursday that this generation is watching its credit scores collapse. The damage extends beyond student loans. As scores fall, interest rates on all other borrowing rise. Credit card APRs climb. Auto loan approvals decline. The feedback loop tightens. The consumer that connects them. These two stories appear unrelated. One is about oil and employment. The other is about student debt and credit. But they converge on the same pressure point, the American consumer in Q2 2026. Goldman's 10,000 lost jobs per month hits service workers, the same demographic most likely to carry student debt. The OECD's 4.2% inflation forecast means their wages buy less. Mortgage rates hit 6.38% on Thursday, the fourth consecutive weekly increase, locking out first-time buyers. CNN reported the housing market recovery that was supposed to happen this year has effectively stalled. The math is compounding. Higher gas prices reduce disposable income. Reduced income increases loan delinquencies. Higher delinquencies lower credit scores. Lower credit scores raise borrowing costs. Higher borrowing costs reduce spending. Reduced spending costs jobs. Goldman's 10,000 per month is not the end of the chain. It is the beginning. Retail spending data for March arrives in mid-April. If the month-over-month number turns negative, the first contraction since September 2024, it will confirm what two separate research notes suggested on the same Thursday. The consumer is being squeezed from both ends simultaneously. Watch the March retail sales report. A negative print would mean the squeeze has already reached the register.